The maximum amount of money that you make, definitely you make while investing in equity. But then equity also, comes with a lot of volatility. You can, allocate a little bit of money into equity, a little bit of money into debt, a little bit of money to understand, that what is the right asset allocation for you. For a young person who's in his 20s, probably he can have much more equity in his portfolio in comparison to debt and gold.
Hello everyone. Today I'd like to welcome you all on behalf of Bajaj Finance Limited for another exciting session. It is a continuous endeavor to empower our customers with knowledge of mutual funds. And to enable this, we invite leaders from mutual fund industry to come and share their expertise and knowledge with us. Today we have with us Mr. Sandeep Sharma, Executive Vice President and National Head from SBI Mutual Funds. Mr. Sandeep, I welcome you for the session.
Thank you, Rohan. Thank you for your invite. Really a pleasure to be here with you.
Uh, at Mutual Fund, he is responsible for expanding the retail footprint of the fund house, and currently he is managing a diverse set of partnerships across banks, MFDs, national distributors, digital platforms, and RIs. Prior to SBI Mutual Fund, he was associated with Kotak, Mahindra Asset Management, UTI Mutual Fund, and LIC of India. Mr. Sandeep is an MBA from Faculty of Management Studies. Today, in this session, we will learn about hybrid mutual funds and its benefits. Well, just like in a meal, we need a right variety and mix of flavors and ingredients. Similarly, to achieve our financial goals, we need a right investment mix, which means we have to diversify our portfolio across different asset classes, which will include equity, bonds, debt, gold, real estate, etc. This process is called asset allocation and which can be easily achieved with hybrid mutual funds. Today, Mr. Sandeep will help us understand different types of hybrid mutual funds and their advantages. Without wasting much time, I would like to hand over the stage to Mr. Sandeep so that he can help us understand hybrid mutual funds in a better way. Sir, please, you can take it ahead from here.
Yeah, thank you. So let me just dive into it. Thank you very much once again. I think it's a very important subject in today's time when we are seeing markets are making new highs every day, and investors are feeling a little concerned about the exposure that they have taken on the equity side of the business. So hybrid mutual funds, as you rightly mentioned, Rohan, offer you an opportunity of having various asset classes within one fund. So let me just dive into the presentation. I'll take you through 5 6 slides through which I would probably try to explain to you the benefits of hybrid mutual funds and why in today's scenario it's very important for people to have some exposure to hybrid funds also in their portfolio. Now, as rightly mentioned by Rohan initially, that asset allocation is a very, very important piece that the investor has to understand, when he's investing. The maximum amount of money that you make, definitely you make while investing in equity. But then equity also, comes with a lot of volatility. And usually what we have seen is that the return which equity funds offer and the returns which an investor gets after investing into equity fund, there is a difference between the two returns. And this difference, as Carl Richards has mentioned, is known as behavior gap. And basically, what do we mean by behavior gap is that since we are invested in one asset class, which is equity, which is volatile, when the markets will go up, there will be a lot of euphoria and people will jump into the market, mindless of what are the valuations of the market. And when there is a correction or a drawdown which happens in the market, people, there is a feeling of fear that emerges, and people exit at the wrong time. So I think it is very important that when we are putting our hard-earned money into any asset class, our objective is to create wealth for ourselves. But what usually happens is because of this greed and fear cycle, we take decisions which are not very conducive to the health of our portfolio. And that's where, asset allocation comes into play, wherein through asset allocation, what you can do is you can, allocate a little bit of money into equity, a little bit of money into debt, a little bit of money into, international equities, a little bit of money into gold, so that on an overall portfolio basis, you are able to reduce the volatility which the equity offers as an asset class. How to really assess what is the right asset allocation? I'll come to that. But before that, asset allocation is like, it is also said that asset allocation is so critical for an individual to consider before investing. And the three major asset classes that behave differently in different economic cycles are equity, debt, and gold. And when it comes to equity, they tend to do well in a rising growth and rising inflation scenario. When it comes to debt, it work well. It works well when the growth is low and it is a disinflationary environment. And gold does well in contracting growth, high inflation environment, also in times of extreme uncertainty. So these three different kind of asset classes can be used collectively, in a particular proportion, and a portfolio can be created out of them. Now, how do you really decide that how much of equity one should have in the portfolio, how much of debt, how much of gold? Now, for that, one needs to make an assessment about the risk tolerance of a particular individual. And this risk tolerance is different for different people. It depends upon what are the goals that one has. It also depends upon the time that a person has for achieving those goals. It also depends upon the way in which an individual behaves when market goes up or down. So it also depends upon an individual's behavior. It also depends upon the current financial situation of an individual, how much of assets he already holds, how much of wealth he has already created, and what is the target that he has in his mind, to achieve, and then how much time does he have. Now, what if a person, for his short term goals, he needs to allocate more to less aggressive assets. If a person probably has not created emergency funds, he has large amount of debt, like he has taken a home loan, etc., then probably his risk profile has to be less aggressive. But if a person is planning for very long term, like retirement or like for children education, certain long term goals, if the individual has already created some emergency funds, he has small amount of debt that he has taken, then probably he can be more aggressive in terms of allocating more towards more volatile assets like equity. Now, let me just come to the concept of hybrid funds. Now, what is an hybrid fund? A hybrid fund has more than one asset class in it. So, it will have equity, it will have debt, and there are certain multi-asset funds which are also hybrid funds, which have, gold also as one of the asset class, gold and silver also. So what really happens is when you have more than one asset class in a particular portfolio, then the correlation between the two asset classes, like as you can see on this screen, the correlation between equity and gold is negative. So what do I mean by that? Now, by this correlation, I mean that if equity goes up, gold tends to go down. This is a correlation between equity and gold. Similarly, between debt and gold, if say debt goes up, the gold goes down. So there is a negative correlation between two asset classes. Now, what happens in a hybrid fund when you have multiple asset classes and these asset classes have negative correlation or very low correlation with each other, the overall volatility of the portfolio is reduced considerably. And back to my original point, that why people are not able to create wealth is primarily because of their behavior. They exit at the wrong time and they enter at the wrong time. Now, what hybrid fund does is that it actually evens out the volatility which equity portfolio has to offer. And by having a hybrid fund in your portfolio, what you are ensuring is that your investment, your wealth creation journey is much more smoother, and therefore you are able to achieve your goals. The certainty of you achieving your goal increases if you have hybrid funds in your portfolio. Of course, people say that if you want to create the maximum returns, then definitely equity is the way. But what we have seen is that this journey, if you are having only equity in your portfolio, this journey is a very, very tough journey, because equity markets tends to go up and down much more, you know. And therefore, if you just add a bit of debt in your portfolio, and that is what happens in an hybrid fund, then what happens is the volatility reduces considerably, because the correlation between equity and debt is very less, and therefore some kind of a even out happens as far as volatility is concerned. If you add gold also to this portfolio, which is again an hybrid fund only known as multi-asset fund, then it further reduces the volatility of the portfolio. So, for an investor, usually what we have seen, their only objective is to maximize return. But what we suggest is that one has to assess the amount of risk that one is taking along with the return. So, always when you are looking at the return, you have to look at the kind of risk that you are taking. And hybrid funds are able to offer risk adjusted return much, much better for a normal investor. So I think that is a very, very important aspect that an investor has to understand, that a particular asset class will not do well every year. So if I really take you to the next slide, which will clearly explain to you over last 10-12 years how each of the asset class has worked. If you see in 2011, the best performing asset class was gold. If you look at 2012, equity, and that too mid cap equity, was the best performing asset class. In 2013, international funds were the best performing asset class. So international stocks were the best performing asset class. In 2014, small cap equity was the best performing asset class. So, similarly, when you look over last 12, 13 years, every year there has been a different winner. And that basically substantiates the point that we are trying to make, that hybrid funds, which have multiple asset classes within themselves, probably is a much better way of wealth creation for an investor who does not know much about the intricacies of each and every asset class. So nobody knows which asset class is going to do well in the coming year. Therefore, having hybrid funds in your portfolio ensures that you are able to participate whichever asset class does well. And I think this is one of the very important aspects why people should have hybrid funds in their portfolio. Just one last point which I wanted to make before probably we can move to the question and answers. Uh, I told you that asset allocation is a very critical aspect that every investor has to look at before deciding to invest. You need to understand that what is the right asset allocation for you. For a young person who's in his 20s, probably he can have much more equity in his portfolio in comparison to debt and gold. For a person who's probably nearing retirement in his 50s, will have to reduce the exposure to equity, and should have more of debt in his portfolio. And once you decide about your asset allocation, then you should move towards deciding what kind of hybrid funds you should invest in. And I would like to now take you to the next slide, wherein these are the various categories of hybrid funds which are available today in the mutual fund industries. Arbitrage fund basically is a fund which is used by individuals for their short term requirements. If somebody has money for 1 to 3 months, and he wants to park that money till the time he uses that money for a particular cause, he can make use of hybrid arbitrage funds. Conservative hybrid funds, probably a person should invest in with at least 1 to 3 year, at least 3 year horizon. Here there is a mix of equity and debt. Usually in conservative hybrid funds, equity is less. Equity is up to 25%, and 75% is invested in debt. So, this probably is very, very good fund for retirees who know, with the longevity of age that we are seeing uh, increasing, even retired people need to have some exposure to equity, and that's where conservative hybrid funds come into play. Another category of investment is equity savings. Now, equity savings has exposure to equity between 30 to 50. Multi-asset, as I told you, has an additional asset class, which is gold, silver, commodities, in addition to equity and debt. So that is what multi-asset allocation is all about. Balance advantage funds have become very famous in last 5 7 years. If a person probably is not clear about the direction of the market, like today is a very very good time when markets are trading at all time highs, incremental money that a person wants to invest, he is a little unclear whether he should put the money today or he should wait for market correction. That's where balance advantage funds come into play, because balance advantage funds increase and decrease their equity depending upon the underlying valuations of the market. And equity hybrid has been a very successful category, which wherein there is a combination of equity and debt, but here the equity composition is much higher than debt. So almost up to 70-75% of the exposure in equity hybrid funds is taken in equity, and remaining 25-30% is taken in debt. So basically, these are the various categories of hybrid funds which are today available in the mutual fund industry. And this slide basically tells you about the time horizon that one should have in mind while deciding which category you would like to take exposure to. So, in equity savings, any of the equity dominated funds, you should have at least 3 to 5 year horizon. And for, as I told you, in arbitrage you can have up to 3 months. In case of a conservative hybrid, it can be 1 year and above. But what we really recommend is that any equity exposure that you have, if you have 3 year time horizon, you will never have a bad experience in this kind of a strategy. So I think, Rohan, I'll stop here, and maybe we can take a few questions if you have in mind.
Uh, Thank you so much, sir. Before we move ahead, and I have few questions for you. The first question that I have is from the investor stage and expertise perspective, how is hybrid fund ideal for a beginner, intermediate, and an advanced level of investor? Just wanted your input for the same.
Right. So I think it's a good question, Rohan. So it's very important to understand today what has really happened in India is that there has been a tax change that we have seen on the debt side. So prior to this tax change, hybrid funds usually used to be for people who were probably nearing their retirement age, because that was a time when capital preservation is a priority, and therefore you would not like to be in 100% equity fund, which will be very, very volatile. But if you really ask me, after this tax change, what we have seen is that retail investor invest, asset allocation is a key if you want to create wealth. So I'll give you a statistics, and it is scientifically proven that whatever wealth creation that an individual does, asset allocation contributes almost 85% to that. Most of the time what we have seen is investors chase returns. Okay, so the best performing fund will contribute only 10 to 15% to your return. 85% of your returns will be because of asset allocation. So, therefore, asset allocation is important for a young, old, any person. And now with this changed, scenario wherein debt has become a lot more unattractive because it entails you to pay your marginal rate of taxation. What we suggest is that when a person is wanting to play out his asset allocation in his portfolio, he should consider hybrid funds as a go-to product in addition to pure equity funds. So say if you in as per your asset allocation, and as I told you, asset allocation gets decided by the kind of risk that you can take, the how much wealth you have already created, what are your goals, how much time do you have for achieving those goals. And that probably an investment advisor or a MFD, you will be able to suggest to him in a much better manner. So once you arrive at the asset allocation piece, then let us presume that you have about 30% or 25% of debt exposure and 75% of equity exposure. That is what your asset allocation is. Then how will you play it? So you have a you have a equity hybrid fund wherein 70-75% of the money gets invested into equity and 25-30% gets invested into debt. So that should become your go-to product. So therefore, even for a slightly aggressive investor, a equity hybrid fund can become a go-to product. So therefore, I would not say now with the change taxation, I believe that if you want to take exposure to debt, hybrid funds will become a go-to product for any investor, whether he's a new investor, whether he's an old investor. If you want to play out debt, hybrid probably is a better strategy.
That was very insightful, sir. I have a second question for you. How are hybrid funds attractive from a tax perspective?
Right.
So, I would like to have inputs on the same.
Sure. So like I shared with you, with the taxation of debt now becoming much higher, even previously there used to be an advantage of indexation benefit which was provided, and even the tax rate was much lesser than the marginal tax rate of an individual. So debt used to be very attractive for people who wanted to allocate money to debt. But now there is no difference between a fixed deposit and a debt fund. You are taxed at the same rate. That's where probably a hybrid funds comes into play. If you want to have exposure, so if you go for a pure debt fund, then you will be taxed at your marginal rate. But if you come into, say, an equity hybrid fund, or you come into a balance advantage fund, now these are all equity oriented funds wherein the taxation is that of equity and not of debt. So you are getting the best of both worlds. One is you are able to play out your asset allocation through these funds. You have debt also in your portfolio and equity also in your portfolio. At the same time, you have to pay a tax which is that applicable to the equity fund. So I think in the new tax regime, hybrid funds role of hybrid funds has increased substantially in anyone's portfolio.
Thank you so much, sir. I have one last question for you, and it's the talk of the town. Headlines like indices, Nifty 50, Sensex hitting all-time high, and there is a lot of noise around these events. And at the same time, it can be a major deterrent to prudent investors. Would like to seek your advice and your view in this current situation, sir.
So see, rightly mentioned by you. People are kind of a little worried whenever markets hit all-time high. People get reminded of, say, 2008, when markets hit their high, and after that we had that crisis, and then the market tanked. So people don't forget any loss that they have seen in their portfolio so easily. So today is no different, but I think we are at a very different stage of the economic cycle. India is changing. India has changed a lot from 2008. Today we are growing at a very good pace. We are kind of the only growing economy in the world. We are growing at a much better pace than even US. So therefore, and our inflation, if you really look at the way in which we have managed COVID crisis, we have come out much more stronger. And whatever opportunities were visible in front of us, whether it was China plus one opportunity, we have actually made use of it. So therefore, the future for India looks pretty bright. And therefore, I don't see much of a concern if somebody really wants to allocate fresh money into equity. But the only two things that one has to keep in mind: number one, that you should not think about short term. If your time horizon is less than 5 years, then don't invest in equity. Okay. But if your time horizon is 5 year plus, I think you will make a lot of money, and you should continue to invest irrespective of all time highs that we are taking. Secondly, the first point that I made initially, asset allocation. So whatever is your asset allocation demands in terms of equity exposure. Don't forget that. So if you have space in your asset allocation to incrementally put money into equity, then you should continue to put money into equity. But say if your asset allocation is 60% equity and 40 debt, and you have already reached 60% equity, then probably you should not put lump sum money further, and you should stagger your investments into equity.
Thank you all for joining us for this session. We certainly learned a lot from Mr. Sandeep about hybrid mutual funds. We are confident that this session will help our investors make more informed decisions to achieve their financial goals. We would request all our viewers to please share their questions in the comment section below, and a team of experts will answer all your queries. Sir, I would also like you to share a few closing lines for our audience.
Yeah, so first of all, thank you very much, Bajaj Finance. Thank you, Rohan, for giving us this opportunity. You guys are doing a great job in terms of investor education. I think it's very critical for us to show all aspects of investing to our investors, and then let them decide about how they really want to go about it, doing it. Another thing which I wanted to share is that India, if you really look at Indian markets, although there is a lot of exuberance that we see today in our markets, but one thing is very clear. In India, there are certain trends which we are seeing very much visible, which is financialization of saving. People used to invest a lot more in gold, physical gold and real estate in the past. Now they have realized that those assets are very liquid, and financial assets are much better to have. So therefore, I'll request your investors that kindly look at the physical assets that you have and try to move them into financial assets slowly and steadily at your comfort. India is going to become the third largest economy in next 5 years, and probably our markets today, we are at about 65, 67,000. We'll touch 1 lakh, and we'll continue this growth journey, because the potential that India is probably the youngest country in the world. So therefore, there are a lot of positives that are there in our country, and therefore, I'll request your investors to move more and more money, at least incremental money. They should move towards the financial markets, and they will not regret that decision. So thank you once again, Rohan, for this opportunity.
Thank you so much, sir. I would like to thank all our viewers for joining us for this session. Looking forward to conduct more of such sessions with SBI Mutual Fund and with Mr. Sandeep sir in the future. Thank you.